In today's Investing for Dummies video, we will discuss index funds. Welcome to Vigilant MD, Lessons Beyond Residency. Once again, I am not a financial advisor, and this video is not financial advice, just free education. To understand index funds, we need to learn what a market index is. A market index is a hypothetical portfolio of assets made to represent a specific sector in the financial market. So investors use several different market indices to understand the health and movements of the market. For example, the Standard & Poor's 500 index, also known as the S&P 500, is an index that contains 500 of the largest U.S. stocks that trade on the New York Stock Exchange and NASDAQ. The S&P 500 index's performance represents the health of large American companies and is one of the main indicators used to assess the overall health of the U.S. economy. People commonly use it as the standard for the entire stock market, and when someone says that their investments are beating the market, they usually mean performing better than the S&P 500. Another famous index is the Dow Jones Industrial Average, which contains 30 large publicly owned companies with consistently stable earnings. The Dow Jones is the second oldest U.S. market index ever created, and it was originally designed to represent the broader U.S. economy. If the Dow is doing well, the U.S. economy is doing well. If the Dow is doing poorly, the broader U.S. economy is doing poorly. Another famous index you may have heard of is the NASDAQ Composite Index, which contains stocks from over 2,500 companies listed on the NASDAQ Stock Exchange. The NASDAQ Composite Index is often used to represent the technology sector of the market because almost 50% of its portfolio is in tech companies. The next largest sectors represented in the NASDAQ index are consumer services, healthcare, and financial companies. Some other notable indices are the Russell 3000 Index, which represents 98% of the investable U.S. equity market, and the Barclays U.S. Aggregate Bond Index, which captures the performance of the overall U.S. bond market. Now, an investor can't directly buy a market index because it is a hypothetical portfolio. What investors can actually purchase are index funds that are created by mutual fund companies to look very similar to the index. For example, if you want to invest in the S&P 500, you can buy an index fund created by Fidelity called the Fidelity 500 Index Fund, or you can buy one created by Vanguard called the Vanguard 500 Index Fund, or the Schwab S&P 500 Index Fund, etc., etc. All of these companies buy stocks to mimic the true S&P 500 as closely as possible. Now, if there are so many options of the S&P 500 index fund, how will you know which one of these to buy? That's where you look at the expense ratio or annual fees. For example, at the time of this video, the Fidelity 500 Index Fund has an expense ratio of 0.015%, while the Vanguard 500 Index Fund has an expense ratio of 0.14%. That's a tenfold difference in the cost. What's amazing is there is a relatively new fund on the block called the Fidelity Zero Large Cap Index Fund, which has an unbelievable expense ratio of 0. That means if you invest $10,000 to invest, Fidelity would charge you $0 annually. What are the advantages of index funds? Number one, index funds have extremely low fees. Index funds are passively managed, meaning the fund manager is not constantly researching new stocks and buying and selling assets to boost the profit in their funds. Rather, the manager simply makes their fund look very similar to an index that they are tracking. This passive management style leads to much lower fees and expenses. The opposite approach of that is called actively managed funds, and they can have expense ratios that are greater than 1.5%, while an index fund usually has expense ratios around 0.2%, and some are as low as 0.02%. Number 2, index funds can provide steady growth over the long term. Index funds outperform actively managed funds over the long term according to several academic studies. Let's say you have a fund manager who has massively beaten the S&P 500 this year. There's no guarantee that that same manager will be able to produce the same results next year. And in fact, even professional managers who have had a great recent track record will show decreasing performance over time. Warren Buffett, considered the best investor of all time, bet professional hedge fund managers $500,000 that the returns from an S&P 500 index fund would outperform professionally selected hedge funds over a period of 10 years. From 2008 to 2017, Mr. Buffett's S&P 500 fund gained 125.8%, and the 5 hedge funds picked by a professional manager added approximately 36%. This helps to illustrate that over the long term, low-cost index funds can produce good results. Now, I'm not saying that index funds won't ever go down, because they definitely do. There will be years when they produce a loss. However, the S&P 500 since its inception in 1956 to 2018 produced an average return of around 8%. Number 3, index funds provide diversification. Since market indices are usually highly diversified, meaning invested in many companies, investing in index funds can be less risky than purchasing a few individual assets on your own. Now, what are the disadvantages of index funds? Number 1, no outrageous gains. While index funds can provide steady, lower risk growth over the long term, they often are far from the best performing funds of the year. This means that index fund investing is a commitment to consistent performance and not massive performance. Number 2, lack of flexibility. Let's say that you notice that the companies in your index fund are massively going down because of some event. If you were in an actively managed fund, the managers would quickly make trades to try to minimize those losses. If you are in an index fund, the fund manager is limited to trying to mirror the index that they're tracking, so that will make them continue to keep these assets that are going down in value quickly. So for people who are savvy enough and experienced enough to handle these situations on their own, index funds can seem somewhat inflexible. Thank you so much for watching my Investing for Dummies series on index funds. I hope you have learned that index funds provide the investor with diversification, steady and consistent growth over the long term with rock bottom fees. If you enjoy this video, please hit the like button and subscribe to my channel and turn on that notification bell. See you guys next time.